Swayam Prabha. Digital India. Educated India.
Topic 1, Topic 2 and up to CD market. Repo market is essentially a secondary market for securities where funds exchange against securities. And the funny thing is that there are various motivations which are at work in the repo market. Why banks, primarily banks involved, why they are repo transactions. Repo is essentially a transaction today with a commitment or agreement about something in future. So it has a forward kind of a market personality or character. Forward markets are you agree something which will happen in future. So we two agree that we would do this in future. Today we agree about that. Forward markets are very common. Exchange rate market में forward market होते हैं, share market में forward markets होते हैं. Repo market is a forward market in the sense that you agree to do something today with an agreement about something also in future which will happen. That future thing is that if I'm selling securities to you, I'm doing it temporarily, not permanently. I will call it back tomorrow on a specified date. So it has a forward agreement. So repo is repurchase. Repo means repurchase agreement. It's a repurchase, which is that agreement that will take place in future. Very different from secondary typical markets for any securities, because secondary market is no agreement about buying it back in future. I sell it means I sold my car. I sold my shares means I sold them, my bonds, anything. It can go to you and tomorrow you can sell it to somebody else. There is no agreement that I will buy it back again from you. So this market is different, secondary market, very different secondary market. Now the motivations are various things are motivate the repo market. In fact, in India we have at least two repo markets. One, under LAF or RBI. LAF is Liquidity Adjustment Facility of RBI. I will explain that in the next topic. They started beginning of this century. RBI started this. LAF, Liquidity Adjustment Facility, where essentially RBI as the central bank or the head of the money market operates through the repo market a kind of monetary policy. It has nothing to do so much with facilitating banks' cash requirements. It has, but it essentially does a monetary policy like thing. Like the municipal authorities do kind of services provide for cities. If there is excess rainfall, they make arrangements for the rainwater to drain out, which they do miserably. They fail most of the time. And if there is a drought, they should make water available. So this kind of a money supply, there is a shortage, RBI makes sure there is enough liquidity in the market. If there is too much liquidity, RBI has to make sure they have to drain out the excess liquidity, which has been a case. I will show you the data. When I started teaching this course in 2008, first time I taught it for these MSc students, third year MSc students, first batch, when I looked at the data, I couldn't believe that bulk of the transactions in the repo market are reverse repo. 90% transactions, more than 90% transactions were reverse repo transactions in a particular year. What does it mean? It meant that there is excess liquidity in the system. which RBI is continuously draining out. So, RBI's point of view that LAF segment of repo on which I have data is essentially a monetary policy, and monetary policy, if our repo is a monetary policy instrument, then you have to remember that there are other monetary policy instruments which also RBI uses. So, it is in a package, in a basket of RBI. Other ones I mentioned, CRR, open market operations, and a traditional monetary policy instrument in other countries which we do not use much, because RBI traditionally does not use it, have not used it in India, is called the bank rate. Now, what is bank rate? Is kind of an interest rate. I will explain that again in the next topic. So, the bank rate, if you look at other countries, European countries, first world countries, even second world countries or third world countries, bank rate is often important, but not in India. In India, CRR, open market operations, repo, these are important. Now, is that all that the repo market? No, there is a market segment of repo on which I do not have data, where banks interact with banks and non-banks, etc. And there the repo transactions are essentially from the point of view of a bank's liquidity requirements. It has nothing to do with monetary policy, because banks individually do not operate monetary policy. RBI operates that. So, it is the bank's requirements, bank's SLR requirements they are required to show some securities which they do not have, and they do a kind of patchwork there. What they do, they go to another bank, do you have securities X? They say yes, okay, take this cash, give that to me for 2 weeks, 2 months. I have to show the SLR, I do not have securities. That means I haven't had cash which I could have invested in securities, which I could show in my SLR. So, do you have securities? And they are particular type of securities also. SLR does not allow RBI any security. They specify what kind of securities. These are the things that you learn, and your understanding of this entire money market will be more complete when I go to the next topic. I take up RBI in details. So, they go for SLR requirements, then for CRR they ask for cash, they sell securities to get the cash. They have to show the cash every week with a fortnight's gap. So, two weeks back, the Friday, the position I had with respect to deposits, I have to show the CRR today with the RBI, not show it, actually keep it. So, from bank's point of view, the motivation is very different, and therefore, there is a market repo on which I do not have data. I have data only on the RBI side, from the RBI side, which is on the RBI's LAF repo, which is monetary policy. Now, earlier there was some trouble, and then they stopped some securities. In the early 90s, there was a scam, and then they brought back all securities. Today, treasury bills, government dated securities, CPs, CDs, they are all allowed in the UTI units. They are all allowed in the repo market to be used as securities. It is a very open market. But when LAF auctions are held regarding repo by RBI, they are held by RBI, they do not allow non-banks to come in, they allow only banks. And some primary dealers like DFHI, etc., they allow. And STCI, Securities and Trading Corporation of India, there are some organizations, institutions. Non-banks I may take up at the end of the course. I will prepare some notes for you on non-banks, which I do not have in the topic list, which may interest you. So, they are not the few primary dealers and were allowed along with the banks in LAF. Non-banks are not allowed to participate. Now, they change things also from time to time. The liquidity adjustment facility on LAF started 5th June 2000. I have the note date, exact date here also. I will talk about that. And the market segment, as I told you, they do not have. RBI does not publish the data, etc. And the idea about repo being, why RBI is so active with the repo market, this idea is, if you look at the money market, which is a short-term market, now banks funding, banks liquidity, how you are helping? You have developed the call market, okay? Then you have this surplus cash to be invested in the treasury bills market, which you have made very competitive, because you have 91-day, 182-day, 364-day, 14-day wala hai nahi, not there. Now you are also allowing the repo transactions, two kinds. One is the market repo, and in addition to that, you have the LIF repo. So what's happening? The short-term money market is becoming very competitive. Now, according to micro theory or economic theory, if a market becomes more competitive, prices should come down and prices should near each other, even if it is a differentiated market. Even in case of a differentiated market where you have different products being sold in the market, like the car market or the refrigerator market, the AC market, and you name consumer durables, competition may not be perfect competition, which we learn in micro theory, maybe monopolistic competition, maybe oligopolistic competitions. But competition does overall one thing. Through competition, the prices come down. Excess prices, monopoly prices do not remain there so much. So prices come down and product qualities improve also because they are competing, and prices also come closer to each other. So there is not much of a difference between products sometimes in terms of prices. All right. So in a particular car segment market, if it is very competitive, you will see the prices are quite different. You will have a difficulty in selecting a Ford product and a Hyundai product and a Maruti product where the cars are very similar. The designs may be different. That's why it's a differentiated market. Now, what has happened is that this active participation of the RBI in the money market, particularly where banks are operating, has made it very competitive. But I have found the treasury bill market also has become very competitive. I'll show you the yield to maturity there are very close to each other, unbelievable. A 1-year treasury bill and a 182-day treasury bill and a 3-month-old treasury bill, 91, all have yield to maturity very similar. Very interesting. So they are becoming competitive and the prices also come close to each other. So this is one of the things they are trying to do, and which I found in Professor Bole's book, RBI's Language, probably. Professor Bole has quoted it at one chapter, I think in the call market chapter or somewhere in the repo chapter, where repo has been discussed, is that they are trying to create an interest rate corridor, short-term interest rate corridor. Corridor means a passage, long passage through which people travel, walk back and forth. So they are trying to create a corridor within which has a boundary walls, within which the interest rates are going to move. They may have short-term fluctuations, variances, but they are within a limit, within a corridor. And I try to plot the data and find out whether the interest rate corridor is there or not, so you can see that data. You can check that yourself, which RBI attempted to do, or RBI still tries to do. And Professor Bole's book has mentioned that language, phrase, interest rate corridor. So we have to see that. So they are trying to essentially make the market very competitive, short-term money market. So this is about the repo. Now, repo is international definition of repo is injection of funds. So the interest rate RBI is asking under LF when it is injecting funds. And reverse repo is when RBI is allowing the banks to park their surplus funds with them. That's a reverse repo. In some ways, as if RBI is borrowing from them. Actually, RBI is, by borrowing means RBI is helping out the banks. ठीक है surplus fund बेकार नहीं पड़ा रहेगा, मेरे पास दे दो, आपको interest भी मिलेगा. So you would expect, therefore, the reverse repo rate will be lower than the repo rate, because repo rate is when banks are asking for loans, RBI charges a higher interest rate. And when RBI is helping the banks to park their surplus cash with itself, give it to me, I will have to go down to give your stuff, and even you will get an interest on that, that rate is lower. So the reverse repo rate is lower and the repo rate is higher. This is what you will see in the data. I will bring the data out for you.
So these transactions are made through security buying and selling?
Yeah.
So when the security is being sold, it is sold at that after whatever the final amount is there, after like paying the interest, at that amount is sold at market price.
I haven't understood your question.
So, for example, a bank has to give its excess cash to RBI. So what would the bank do is buy RBI securities or just give the cash?
No, against securities. RBI is giving securities.
So now when the RBI has to take back the security, will it pay as per the amount that has been created after paying the interest? Not at a market determined price.
Market, it is, they call it market determined because this rate is decided through an auction. RBI agents, people and banks, etc., who are participating in the repo market sit together and there is an auction and the discount rate is decided there, both the repo and the reverse repo. And since they are not dictated by RBI, they call it market. But not a purely market because there are other participants who often are non-bidders, just like treasury bills, who will have to accept the rate. So the bidding is allowed only by a selective group of participants. So it is market, not purely free market, market to some extent as opposed to RBI prefixing it. RBI could have said this is the interest rate, jao, lena hai leo na lo. That's not the case. They negotiate through auction. So that, in that sense, it's market. But there is a market repo where no RBI is there, where banks interact with banks and non-banks in the repo market. That data I don't have. That is a pure market segment of repo. And this LF segment, they call it market determined repo and reverse repo rates, where auctions are held. Clear? ठीक है? ठीक है? Okay. Now, I come to, it's good news, I come to the last but very important point. This I have been studying since I was in college and we were given some English books where in England this concept first developed and there are famous economists who wrote books and discussed these issues. And I used to wonder what's the relevance to India because I don't get anything about India. Finally, when I got something about India, it's all very negative. It's still very negative about India, but this thing is very important. Without talking about it, I cannot close money market. This is called commercial bills. This is called commercial bills. So I have to talk about it. And only after I've talked about it, that I can close this topic. Commercial bill market I have to talk about. Often it is referred to as the bill market. Oh, I tell you, it used to be so boring, but the books are great books. Some of the books may be in the library if you want to know about the English system, how it started. I read about England, the bill market in England. Sayers, one famous author used to be when I was a college student like you, first year, second year student. What are Sayers? S-A-Y-E-R-S. Sayers' book was famous on banking, wonderfully written, very well written, English author. Now, a commercial bill, like you know, in case of CP/CD, I used a term like usance promissory note. In case of commercial bill, there is a term that is used to describe it. It's called negotiable post-dated check. Term is used called negotiable post-dated check. Negotiable post-dated check. This is, I mean, the more our system will get organized, Indian system, Indian markets, etc., the more you will have the commercial bill market acquiring importance. But the commercial bill market has not acquired much importance in India so far, because our money market, if you look at it, is so much of that, even the entire economy, so much of that is unorganized market, and there's a huge black money thing there. Some people used to say it's about 40–50% of our GDP, and so much of unorganized sector that the commercial bill market really couldn't develop much. So what is this CB, negotiable post-dated check? It's very simple. And you will also understand and appreciate probably why it is important. The entire business world, the economy, where the economy lies, the market world, works on the basis of a few features like trust, future payments, borrowing. They are based on that. So I will produce some goods. I have to do so much before finally I can produce the goods, and the production itself can take time. Sometimes some items take 6 months to produce, or 2 months, or 1 month to produce. Now, what I have to do? I have to arrange for the raw materials. I have to first have the plant, then I have to arrange the raw materials, then the labor, and then have the production plan, have a future output target, and produce, determine the prices, find the markets where to sell them. So it's a lot of work. That's why not many people wishes to become an entrepreneur, because it's just so much work. It's easy to go and work for somebody, get a salary at the end of the month, come home, forget about the rest. Otherwise, if you're an entrepreneur, you have just so much headache. Everything you have to take care of. Sometimes for a new company, the entrepreneur doesn't have much helping hand. In an established company, the entrepreneur is supported by, all kinds of people he can hire. He can hire the CEO, the board of directors can have the managing directors, the other specialists around, who then do the work. But when it's new, you have to do the work. Now, what is happening here is that when you're buying the raw material from the raw material supplier, and you are yet to earn enough revenue, or you have sold something where the revenue hasn't come, because the agreement there has been 6 months later they will pay. But you're going to stop your work here, you're going to stop production here. So you have to keep on paying the workers' wages, the overhead fixed costs, electricity bill, water charges, other rents, the raw material supplier you have to supply. Now, what happens is that often these, other than the essential ones like the raw material supply, you may also get into some sort of an loan kind of a system where you buy the goods, but you don't pay it today, you promise to pay later. Now, therefore, the trust becomes very important. Therefore, it becomes very important that when you are not paying him, when he has sold something to you, and that may be located in 2 different cities, one is in Madras, one is in Kanpur. They don't know each other that well. They are not neighbors. They did not grow up together going to same school. They have never seen each other. Now, so there these agreements are required where post-dated checks play an important role. That I don't pay you now, I can write a check, but you will get the payment 6 months later or 2 months later. Therefore, the question of trust comes, whether I would sell goods at all to this fellow in Kanpur, because I won't get the payment today. So, because of this nature of business where things don't happen right away, it is often based on borrowing, future payments, forward contracts, a repo you have just seen. This kind of an institutionalized system which you have, it is important that banks play a role, where banks can stand a guarantor for that seller, saying, don't worry, I know this buyer, I know his financial standing. So, if you sell goods, it won't be defaulted. And worse come worse, I am going to keep some assets of this fellow. so that if he defaults, I will pay you that amount. So now you are going to get into various complex negotiated deals, agreements, where goods have changed hands from the seller to the buyer, who is also a producer maybe, of course, but the payments have not been made. There where commercial bills come. They are nothing but negotiable post-dated checks. So the two parties have to negotiate, okay, you will pay me 1 month later, but 1 month later that I have to wait, you just cannot pay me the price that I have shown, which you could have paid if you had, which you would pay if you pay today. But if you pay 1 month later, you will have to pay more, because I have to wait out 1 more month. So they agree into like a legal agreement, like going to a court on stamp paper. There are stamp papers available from court on which you can formally agree in the presence of lawyers, etc., with proper signatures and documents, that this is the bill that we create. So they can go into a very formal negotiated deal where both the parties agree when the payment will be done. And that's how a commercial bill comes into existence, and is essential to the functioning of the business world. But the more the business world is in the underground, the less we know about these commercial bills, the less commercial bills are supported by the banks, because the banks belong to the organized world. If the banks belong to the organized world, they don't have much confidence to support the commercial bills of the unorganized market. So the bill market is just not developing in India, still not developing in India. I will show you that. Okay. So it's a very important topic I started today. I will go very slowly. There are various kinds of commercial bills. It's very interesting also. To me, it's very interesting also. Now, so commercial bills are post-dated checks. Fine. Negotiable, everybody. And an agreement basically between a seller of goods and a buyer of goods. Now, suppose the seller is A and the buyer is B, and B has declared that I cannot make the payment today, I don't have cash, I will make the payment 6 months later. A then draws a bill, that is writing a bill, which B has to agree. A then draws a bill stating the amount that B is required to pay on a given date. A specific date will be mentioned. B then will acknowledge the bill by countersigning or whatever his obligation to pay the written amount. A, who has sold the goods, who drew the bill, who wrote the bill, and make B, who is the buyer of the goods, to agree to that, acknowledge that. A is called the drawer of the bill and B is called the drawee of the bill. So two parties have formal names, the drawer of the bill and the drawee of the bill. And the drawee of the bill. The guy who is supposed to make the payment in future. And the guy who sold the goods didn't get the payment, the poor fellow there. So he has to go through, but he has to run his business too. So he cannot say, I will only sell goods to, he probably cannot have the freedom, he doesn't have the freedom to say, I will sell goods only who can make me payment today. Of course, that will be the first preference. It's just the present discounted value concept coming here. Since he will make a payment in future, and today is more attractive than future, in future if he has to wait, he will have to pay more to make it equally attractive. Present discounted value, again coming here. Because this guy, what he will pay 6 months later, the present discounted value would be smaller today. The interest rate again coming into the picture, therefore commercial bills do carry an interest cost that he has to make to wait. Throughout money market, you will find the existence of interest rates, whatever be the context. Same thing, present discounted value stuff coming out here. Oh, 6 महीने वेट करना पड़ेगा, ज़्यादा देना पड़ेगा आपको. आज देंगे कमीशन मिलेगा, सस्ता में हो जाएगा. Today is more valuable than tomorrow. But tomorrow you have to do, to make it valuable, I have to add more monetary terms to it or whatever, value to it. Achha. Now, drawer and the drawee, once, this is very interesting now. Now look what game starts. Once the bill has been acknowledged by both the parties and it is a proper commercial bill, and a smart guy will make it acceptable in the eyes of law, make it legal with proper documents, etc. Now A suddenly has wings flying. In a proper commercial world, he even doesn't wait 6 months. What he does, he goes to the bank and cashes it. He says, here is a commercial bill, I sold these goods to him, seller in Kanpur, company X. And he says, oh, yes, we know the company, bank has to know. He will make this amount of payment later, but if you give me cash today, you can have this amount of income because I will ask you, give you a discount on it. So the bank purchases it at a discount. Bank waits out till maturity and cashes in finally by recovering the money from that buyer in Kanpur, the drawee, 6 months later, and makes an income. So this fellow actually what he does, he draws the bill and he can even benefit because the price he may extract from the bank is higher than, he is getting the cash today, higher than what he would have got, he would have received if the buyer of those goods have made the payment right away. So part of the interest he recovers immediately and makes an extra, he benefits, and you can see this justifies the existence of commercial bills, because if there is a commercial bill situation and both the parties can trust each other, they benefit. And the intermediary who was nowhere in the picture probably suddenly finds a windfall gift. अरे ये टाटा कंसल्टेंसी खरीदे है, ये तो कल पेमेंट करेगा ही. Who would mistrust? Buy the bill immediately. Bank makes a profit. So it's the whole range of reward system make it survive the commercial bill. Very interesting. Now, if your parents are in business, ask them about commercial bill if they know. So now he can go to the bank, sell it bill. So secondary market is immediately created. Secondary market, he sells it off. Bank waits out till the bill will mature and then finally change the amount at maturity, get the money, and bank goes back happy home. Goes back home with that money in its pocket. Now, having told you about this basic concept of commercial bill, what I have to do, I will have to tell you about various kinds of commercial bills that exist. Before I tell you, I will tell you a story about in India where commercial bills are mostly found, not in the organized market, export-import market mein kuch hai, not in the organized market. So international commercial bills are created also, internationally. But our bulk of the commercial bills are in the corners and the pockets of the origin of Indian industry, which is the wholesale market, this and that, the trading communities, which started God knows 100 years back, 150 years back. And the commercial bills are operating there, you won't believe me, the commercial bills are working there, which are hardly any legal document. एक कागज के ऊपर, often if you go to a wholesale market, you will see there is a clip and some small size papers, and it looks like a small pad. It is not actually pad, loose sheets, and we don't have a habit of writing cash memos. And you bought something, they will write something on it, maybe a date is mentioned, not even a signature, not even a rubber stamp of the shop there, forget about a company, not even the rubber stamp of the shop, something is written, this is you have bought this amount, and a date is given, and that is a cash memo that they give us. I have seen that happening. Commercial bills in our economy is often traditionally created like that on a piece of paper. And how does it function? Because when it comes from this shop, maybe with a rubber stamp now, because it's a commercial bill and the payment will be made in future, they all exist and coexisted for years, centuries, Baap Dada se ek saath. They know each other very well. Within that closed domain, commercial bills are operating all the time. and though there is no mistrust. So, if a foreign expert ever looks at these commercial bills of Indian wholesale market, trading community, etc., business community, commercial, they would get extremely surprised. Cannot believe probably commercial, because to them commercial bill is a very formal document. It's like a legal paper. It's like a, you can take it to a court and get it accepted by the judge, would look at it. But here commercial bills on a piece of paper with a rubber stamp, signature भी पता नहीं चल रहा है किसका है. Commercial bill तैयार हो गया, कल payment होगा. So, it's unbelievable how the Indian economy, and something, so long people trust, the business community would trust that method of creating commercial bills and that kind of commercial bills, there won't be any problem. However informal, however shabby, however untidy it may look, however incomplete it may look, like a proper, in comparison to a proper commercial bill, there is no problem with the business community. They lived with that, they've seen that from their childhood, these commercial bills. Often future payments are made within the market, or between the producer and the market, and the producer is there, God knows for how many years they are supplying it. And the wholesaler who first purchased the product have no lack of confidence there. So, a simple commercial bill like that will easily work.